everyone. Welcome to our fund manager's interview session today. My name is Zane Pulumbarit and I'm the Senior Funds Analyst of COL Fund Source. So in our interview today, we will talk about the Philippine market. So from the lows of October, the market has rallied below 6,000 to a peak of above 7,000 in the first quarter, which is equivalent to around 18% return. Now that we're seeing the strength soften, particularly during the sell-off we experienced around April, let's talk about what are the views of the market today. So to help us make sense of the ebbs and flows of the local market and to give his views on where it can go moving forward, we invited Zerge Zandueta. He is COL Investment Management Inc.'s portfolio manager who is in charge of handling the stock selection and the asset allocation of CMI's flagship fund, the COL Strategic Growth Fund. Hi, Zerge. Good afternoon.
Yeah, hi Zain. Good afternoon. How are you?
All right, good. Okay, so wag na tayo paligoy-ligoy, Zerge. Let's get right into it. So on
Okay.
April, the local market went down by around 8%. Right? So it had a very quick turnaround. So siguro maraming investors nagtatanong, wow, we had such a strong run from November hanggang around March, and then suddenly the market fell. So can you give us a context on why Philippine stocks have been very erratic lately, and what does it mean?
Yeah. All right. Okay, sige. So thanks for setting the stage, Zain. So I think that's a very pertinent question in the minds of a lot of our investors. So if I could just share my screen. So this is a chart of the market, especially as what you were pertaining to earlier. No, it had a big rally from the fourth quarter of last year, and then it went to as high as 7,000 in the middle of the first quarter, and then after that, especially during April, we saw the very big give back. So I want to begin by saying lang that whenever you're trading the markets, profit taking, especially whenever you see huge run-ups, is a natural offshoot of things. So there are specific reasons why as to the profit taking wave could have been characterized as faster than what you would probably normally expect. And we would I would touch on that in a while. But in general, I think this is really profit taking. And I think a theme of the market that's going on right now is actually one of delays. If you guys would actually recall, going back to, like, say, since 2019, 2018, 2019, even the early 2020s, the market had this pattern of having a strong January and then reversing come February or March. So you saw that dynamic at play during the past several years. And parang this year it wasn't there, right? Nangyari lang siya actually nung April. And what triggered that? So actually even before that, just to touch on in terms of the performance of the Philippines, as you mentioned, very strong first quarter. In my opinion, actually quite justified. So if we rank in terms of the ASEAN, second best performing market, yung Philippines, next only to Vietnam. And I think it was justified on several counts. So local fundamentals were very good in a sense. We were the second fastest forecasted GDP for the year. And then our PE, if you look here, it was just 11.7 times as of the end of first quarter. So that's actually second cheapest next to Singapore. But the difference also, of course, of the Philippines versus Singapore is that we are a growing market, whereas Singapore is very mature. And another factor in terms of actually what helped the Philippines more this year was the outlook in terms of what our central bank would do. Markets were anticipating rate cuts for the Philippines also this year. So there was profit taking though that hit after the first quarter was over, and these are just some of the several culprits. So primarily it was really inflation numbers that were sticky. So if you would recall, what was the primary reason as to why, let's say, the Philippine market and global markets in general rallied since the fourth quarter of last year? It was because of the so-called Fed pivot, when Jerome Powell came out in December and said that they were looking at 3 possible rate cuts for this year. And based on the studies that we made, and we will show some visuals of that later, normally the trend in the Philippine market and the stock market is when interest rates go down, asset prices such as stocks tend to go up. So the issue with inflation, the prints that came out for the first 3 months of the year for the US, parang it was yung tinatawag natin na sticky. So the Fed, what they want is for this inflation number sa US to be around 2%. But the problem is the data points that have been coming out had been sticky in the high twos to low threes. So parang nasa 3% siya. Hindi siya bumababa, as you can see there in the chart. And in terms of the Philippines naman, sequential acceleration from a year-on-year basis, parang 2.8 to 3.4 to 3.7 first 3 months of the year. So it was because of these things that the market started scaling back expectations of the Fed possibly cutting rates for this year. And then I think the element that was not part of the calculus is that there was a brief moment in time where nagkatakutan na, oops, baka what's going on in the Middle East could escalate into something further. So just recently, Iran started attack Israel, and I think Israel also had some sort of retaliatory action. So I think this is something that is a bit of a wild card and something that we need to continue watching. Not only because of number one, you see the price there of oil, it has gone up around the same time that these issues were coming to the forefront. So Philippines parating sensitive yan in terms of oil prices because we import a lot of our oil demands. And oil is 15% of our inflation basket. But for me, like even from like let's say, I mean just a general standpoint, but Israel and Iran, these are countries that both have nuclear capabilities. So anytime something heats up here, mas nakakatakot siya. And then of course, US is an ally of Israel, but you always fear what happens if they would get drawn into war as well. So you have these dynamics at play. And then commodity prices also went up by a lot. So Philippines, diba, we import a lot of the raw materials and commodities that we need. Commodity prices shot up. So ito, several factors that would relate here. One is geopolitics. One is, of course, the issue of El Nino. Yan, nararamdaman natin lahat, nararamdaman natin ang init-init recently. So all of these things could put pressure in terms of the sentiment. So that's really what led to the profit-taking wave and some speculation in terms of what are the amount of rate cuts that would be warranted for this year. So this has been one of the biggest drivers for the market rally. And when this started, when the year started, people were expecting up to 6 rate cuts from the Fed. And then as the weeks progressed, it got scaled back from 6 to 3. And then nung lumalabas na yung mga sticky inflation figures, 2. And then the latest naging 1, diba? And may mga iba pa nagsabi na, oops, actually baka the next move might even be a rate hike. So thankfully, at least we're a bit over on the other side right now. In fact, as we're taping right now, you've seen that markets have rallied quite a bit after the corrections that we've seen initially directly from the end of March. And that's because bumabalik na ulit yung potential for rate cuts coming in because they're seeing that the US economy is slowing down a little bit. And then inflation, there are some secondary indicators showing na baka hindi naman talaga siya pick up. And of course, the geopolitical tensions also quieted down quite a bit. So this is really the reason why there was a profit-taking wave that hit. Now, as to the question, bakit si Philippines sobrang erratic yung galaw, the only explanation I could really think of behind that is this one. So sadly, for the Philippines, yung problema natin is liquidity. So we're a much smaller market compared to other markets in the world. And normally when the foreign investor here wants to get out, normally the market can fall very quickly. And in fact, after the first quarter, that's what happened. So during 1Q, we saw a net foreign inflows of about 9 billion. So mind you, that was the first time we've seen net foreign buying for the Philippines. I believe since 2020, I believe since 2020, second quarter of 2023. So they haven't really been buying for multiple quarters now. So nagsimula lang ulit ng first quarter. And then come beginning second quarter, nagbenta na sila ulit when all of these issues that I just mentioned started propping up. So the problem with the Philippines is because we are very illiquid. When a foreign investor wants to sell, nobody's there really to catch it. So what I have here is just the annual PSEI volume in billions of US dollars. And as you can see, since if you go back 10 years, the annual volume of the PSE as of last year is actually down 50%. So this just really tells you people are not participating. And after, like let's say, maybe the Philippine story of the past decade, wherein we got all of our, let's say, sovereign grade investment rating upgrades, but there was a lot of excitement in the market. More recently, a lot of that excitement has toned down. So not a lot of volume came in. And that's why when somebody wants to sell, there's nobody there who wants to take the other side. So for me, it's not actually necessarily a negative, especially if you're a Filipino investor. Actually, all this does is it helps make prices more attractive in a sense na there could be opportunities that prop up because biglang just flash in the pan, may malalaglag ng malalim kasi walang sumasalo, there's no liquidity. And especially if like for us, for Filipinos, we know the market, we could also be in a better position to capitalize versus a foreign investor. Yep.
Right. So you mentioned Zerge, no? Maraming factors. You mentioned inflation, rate cut expectations, geopolitical tensions, even the El Nino that we're experiencing are being factored in by the market. And because of the lack of liquidity, sobrang sensitive ng market natin to these types of events.
Yeah.
But from a structural point of view, is there something that investors need to be worried about? Is growth slowing down? Is inflation expected to remain higher? So what are you sensing from these mass structural and mass sustainable growth for the Philippines?
All right. Yeah. So yeah, thanks for that question, Zane. So actually, in terms of like structural issues, let's say maybe to the magnitude of a crisis level collapse, to be honest, we're not seeing anything in particular to that degree. In fact, actually, the way we look at the market now is it's actually attractive. So from a valuation standpoint, we are at least around 2 standard deviations already below the 10-year mean. So we're just trading at around 11 times PE. So that's in fact very cheap. What is what you could call maybe the closest thing to something that's being structural in terms of challenges is competition in the form of higher interest rates. I think yun talaga siya. And even if you look at the, like let's say, the dynamic during the first quarter, why is it that investors appear to be so skittish? Take profit agad, di ba? And ang lalim agad ng nilaglag to market. It's because for a lot of people, there's option now in terms of fixed income products that was not there over the past decade. So what I just showed here lang is this is the chart of the Philippine index. That's the blue line, and Philippine 10-year rates. And what I shaded there in gray are the points in time where you saw 10-year rates peak, and you would see that it also coincided with, like let's say, major bottoms in the Philippine market. So of course, the issue with high rates is, aside from investors having choices, even if you look at it from the standpoint of companies, there's also pressure for them because definitely borrowing costs will be higher. It's more difficult to do business. But over time, what we actually think and what we believe is that at least this high rate regime is a higher for longer regime, or it's more of a high for longer regime rather than it's a continuous higher for longer regime. I think just based on our analysis, the way we see the markets at the moment, I think like let's say central banks or like let's say at least in particular the US Fed, them cutting increasing interest rates some more seems like a lower probability scenario to me. At least given the recent speech also that Jerome Powell had. I think his bias and the Fed's bias really at this point is to more of try to avert the hard landing. And I think they want to cut and they just really want to wait for the data to justify it. But sadly, especially like I say right now, while interest rates are high, investors will have options. Hindi na siya the Tina type environment of the past decade. There is no alternative. Right now, there is an alternative. So, but the way I also look at it, especially being an investor in equity markets itself, is that normally if you look at it like it's over longer periods of time, but they always say the equities are the best performing asset class. So that carries over even in periods of when interest rates were very high, very low. At the end of the day, equities talaga, lumalaban siya, bumabawi siya. And the reason behind that being is that the equities that you invest in, for them to actually to survive, to remain listed with the PSE in the index, they need to be able to weather storms like this one. So like it's ibig sabihin yan, if mataas ang interest rates ngayon, di ba, for your business to remain viable, you need to be able to continue earning at a rate much higher than the level of interest. And at least if you look at the Philippine market, diba, like especially the blue chips, the companies that we have that are able to survive, those are companies that are able to do that. So actually for me, one of the ways that I look at this, even though interest rates are high, that should also mean that from the equity investments that you have, the expectation is that it should also have a higher return. So that doesn't always have to follow or be the case, especially as things are transitioning. But once things normalize, and I think the type of environment that we have right now from a rate perspective is one of normalization. Diba? Like let's say kahit na magsettle yung US 10-year rates at around 4%, 4 to 5%. But that just means na once companies are able to adjust to that level of interest rate, for their businesses to become viable, it needs to give you a return always that's over that. So after that adjustment period, you need to review what are the companies that will be able to remain to combat that level of interest. And the ones that are still there, are remaining, are doing well. That's where you want to be invested in.
All right. So you mentioned Zerge, no? There are good things to be optimistic about the market, particularly valuations still look cheap, right? Although may concerns in terms of the inflation and interest rates, companies that are strong and growing should be expected to perform higher than interest rates kasi that's what they're being generated or paid for. No? So yun pa rin yung advantage ng equities in that once these companies perform, they could have a higher margin than your interest rates or mas malaki yung gap they could provide over the long term. Okay. It's a good thing, Zerge, na you mentioned fixed income and bonds. And now they are a good alternative for investors today, especially with the high rates that we are seeing. Now, kayo sa CMI, you're a portfolio manager for CSG or sa COL Strategic Growth Fund. And one of its most unique feature is meron siyang flexible asset allocation. So pwede siyang mag-invest in bonds, pwede siyang mag-invest in cash tactically to take advantage of these opportunities. And since you're looking at both, you're looking at stocks, you're looking at fixed income, right? And given your views that interest rates could stay higher, but over the long term, stocks are still your best pick. How are you positioning in this type of environment? Should you be more on stocks? Should you be more on bonds? And how do you plan to navigate it over time?
All right. Yeah, thanks for that, Zane. No? So actually right now, we have an equity bias. So the portfolio, so this is as of last Friday, May 3. We're actually tilted more on the equity side. So about 60% of our portfolio is in equities. So mind you, it's not higher at the moment, like 70 or 80, because there are still some risks that we see out there that need to be at least factored in. But the bias, in our opinion, should still be equities. So I'll just caveat this also by giving our listeners some context. So our equity position, actually, this came from around 70% around the first quarter. But we trimmed it by taking profits when we saw the market was approaching that critical 7,000 resistance mark. So now that the market has fallen, so we're actually watching that 6.4 level very closely to see if it could really firm up as a solid support. But we're watching how things develop from here. And our bias actually is to look for opportunities to increase the equity stake from 60%. So ideally, we want to be able to bring it somewhere around 70 up to 80% as we gain greater conviction over how the market shakes out from here. So based on a study that we had over the past 20 years in terms of the historical behavior of the Philippine 10-year interest rate and the PSEI, what we noticed is there's a tendency actually for the PSEI to rally when Philippine 10-year yields are going down, when interest rates are going down. Now, I mentioned earlier, diba, in our discussion that that's one of the challenges to the equity market right now. It's that interest rates are high. But what happens historically when interest rates go down is that equities tend to perform and develop. And in fact, that is our expectation at the moment. So rates are going to stay higher versus where they were over the past decade, but they might go down lower from the level where they're at right now. So over the past 20 years, what we've observed is when the Philippine 10-year rate declined by at least 100 basis points, the average equity return of the PSEI is close to 10%. So this is something that we're scoping out as a possibility. Now, based at least on terms of what the Fed has mentioned recently, based on how Jerome Powell sounded during the last FOMC meeting, it really appears like their bias is to ease. They're looking for reasons to cut interest rates. So whether that's politically motivated or whatnot, but we can never really know for sure. But even if you just look at the dot plot of the Fed over the next 3 years, 2024, 25, 26, the Fed members expect interest rates to go down. Not back to zero, but lower from where it is right now. So historically, when interest rates go down, and based on what the study shows, equities tend to perform well. And even if you look at it also from a fundamental standpoint, rate cuts will also justify a higher price target. So April and COL and the research team, our base case for the Philippine index is a 7,100 market for this year. And that's based on a 10% earnings growth of of corporate accounts while maintaining your expected PE, your expected valuation range. There's no multiple expansion that comes in. But if the BSP cuts rates, there could be room for multiple expansion, while maintaining your risk premium over fixed income. So based on our computation here, you could see 7,500 stock market justified by if the BSP is able to cut rates this year. So of course recently yun na nga yung naging challenge, no? Baka ma-delay yung rate cut both ng Fed tsaka ng Philippines ng BSP. But I think as long as the tone, the bias, the angling of these central banks is still to cut rather than to hike, that should make for a more bullish equity environment.
Okay. So, yung bias nyo on equities right now, Zerge, is that you're seeing the potential appreciation ng valuations because of the rate cuts down the road.
That's
Right.
correct. Yeah.
Okay. So in terms of your equity preference, meron ba kayong particular themes in the market that you're looking at?
Yeah. So actually, in terms of like let's say sectors and themes that we like, I would classify our stance as being strategically defensive and tactically opportunistic. So ano ibig sabihin yan? So in terms of the issues that we want to buy right now, where we feel we could hold them for the longer term and be able to rest and sleep easy at night, we want to be positioned in stocks and in sectors that have a defensive component to it. Meaning we want something that has number one, earnings resilience. Meaning like kahit na mag-iba yung economic condition, yung earnings ng company na bibili natin will most likely remain intact. So what are companies like that? Diba? Normally, those are power companies where they have, like let's say, their contracts secured over the long term. You want, like let's say, banks, for instance, that are positioned, like let's say, for example, here, naka-highlight China Bank, where bulk of their client base is wholesale or corporate. So yung mga makakabayad talaga, di ba? You want utilities given guaranteed yung rate that they could charge investors. So at least we know, even if like let's say there's a slowdown that really happens, diba, because interest rates are high, at least these guys will continue to earn. And another component of being defensive that we want to pay attention to is the dividend yield. So we want to buy stocks at this point that are paying you a good dividend, because the waiting period, diba, could also be long. So the good thing, at least in terms of these defensive issues, the tendency is they also pay higher dividend yields. So a lot of them, as you can see here, close to 5%. And additionally, you also want to buy the things that you also want to buy right now are issues that are cheap, that are trading at low valuation multiples. And the reason behind that is because yun nga, mataas yung hurdle rate, well, mataas yung interest rates, diba? So it's hard to justify, like let's say, a stock that's trading at 20 to 30 times PE. When if you look at the Philippine market, parang hindi naman ganun yung growth dynamic ng Philippines eh. Wala naman tayo dito, for example, diba, like mga tech companies that are growing 50 to 60% every year that would justify a very high multiple. So dito, the growth of our companies here, most of the big caps here is around the 10% range. So ideally, you want to also be selecting issues that are trading at low PE multiples. So yeah, so strategically defensive, meaning we want the bedrock of our portfolio to be in companies that show earnings resilience, are cheap in terms of their valuations, are still able to grow somewhat and pay a good dividend. And then when we say tactically opportunistic, and yun nga yung maganda sa CSG, that we're able to park a portion of the portfolio in interest-bearing options, is that eventually, diba, when prices come to you, to the levels where you want, to the levels where you have greater conviction, kasi alam mo, kahit paano siya balik-balik na rin, mura na, pwede mo na siya bilhin. And then of course, the technicals line up and eventually the sentiment lines up. That's when you want to deploy. So tactically opportunistic means we also want to be ready to take advantage of trades that might open along the way. So like let's say yung mga PSE rebalancing, FTSE, MSCI rebalancing. Diba? I mentioned earlier when we started our discussion that one of the problems of the Philippine market is that it's highly illiquid. But at least dahil illiquid siya, it also tells you the market is highly inefficient. And when there's inefficiency, you could exploit it to your advantage. So sa US, like let's say for instance, mahirap na maglaruin yung mga MSCI, mga rebalancing. Dito, to some extent, kaya pa eh. So yeah, so that's why, I mean, that's why there's a bit of fixed income cash portion there. So able to play on these potential trades when they arise.
Okay. So the
Um,
focus,
yeah,
yeah. So
sorry.
the focus right now, Zerge, in terms of your stock selection, is really focusing on companies that have good earnings, right? That are likely to be unaffected by the different factors that we're seeing in the market today. So they're more defensive in nature. But at the same time, you're also tactically looking for potential opportunities to buy in. So when markets pull back, draw down, make correction that is because more of liquidity than because of the fundamentals of the market, you're ready to take on a bigger portion during that period. So it's a good balance of defense and offense.
Yeah, that's right. That's right. And I think it should just be the case that the stress at this point should be on defense, because we think that there could still be some potential trouble spots at the moment. So like let's say when markets fall very quickly, yes, we could say most likely it's because of profit taking and the fact that things are illiquid. But at the same time, you also need to as a fund manager or somebody who manages money, diba? You always need to open your mind also with what are the potential risks but talaga that are out there, and is there something that we're not seeing that should really raise alarm bells in your mind. And kapag iniisip ko, like let's say yun, and that's also part of the reason why we still need to be a little bit defensive right now, even in terms of our placement and allocation. It's because there could still be potential trouble spots along the way. So I would not, like let's say, accord a high level of probability in terms of these things potentially happening at this point. But these are actually some of the potential trouble spots that are out there, no, in our opinion. So first of all, the US hard landing, I think you cannot definitively rule it out there. Um, Definitely the consensus has moved towards a soft or no landing type of environment already for the US. But as we know, monetary policy really acts with the lag. And even in certain occasions in the past, diba, wherein people thought na soft landing na siya, biglang nag-hard landing pa rin yung US market eh. And what I've been hearing of a lot also recently, at least in terms of the US jobs market, is when the jobs market unwinds I mean, like right now, it's still very strong. But once it unwinds, once something wrong goes there, it tends to happen in a hurry. So that's still an outside chance that there's an US hard landing that could take place, and we need to be aware of that because as April also always likes to say, when the US sneezes, the rest of the world, including the Philippines, catches a cold. Next is the Fed. If the Fed hikes rates, I think very, very remote chance of this happening, especially given what Jerome Powell also said last week. But like I say, inflation in the US comes out next week. But what if all of a sudden it's a much higher number, and this discussion is again back there on the table? So that's also the problem with the Federal Reserve right now. But the fact that they want to be more data dependent also means that their outlook could also be a little bit more susceptible to swaying from data point to data point. And then last, which is really out of anybody's control, right, is if just geopolitical tensions reignite. So thankfully it's more quiet now, but that's something that could still happen and take place. So the problem with the Philippines, given that we're more vulnerable, I can see especially in terms of commodity prices, I mean, it doesn't even need to be full-scale war, diba, that takes place. Umakyat lang ulit yung presyo ng oil, ng rice, all of these things. I mean, apektado na agad tayo in a negative way. So, yeah.
So what I'm getting from here, Serge, is that there are still risks that you are watchful of. And that's why your allocation right now, meron pa ring defensiveness. You still have exposure to fixed income, and the stocks that you're selecting are also more on the defensive side, right? In case these risks materialize. Okay.
Yeah.
One of the main differences nga is that it has a flexible asset allocation. So can you explain how would this be different from your traditional index fund? When would one prefer to have an index fund, or when would one prefer to have CSG instead?
Sige. That's a good question also, and I would like to answer it now by going through some slides that we prepared to at least just be able to give our audience better context. So if you could like see my screen now. So this is actually this study is not just in the Philippines, but it's also replicable amongst many other countries. But in general, and studies have shown that stocks tend to be the best asset class over the long run. So this one is a 20-year study. We just charted out the performance of what it's like to invest in the PSI index. So that you could say that's an equivalent of an index fund, bonds, and money market. And as you can see, in terms of like which performed the best over the past 20-year period, it's the stock market, PSEI index, like I say, you can call it index fund, up roughly 350% over that time frame, above about 8% on average performance every year. But if, as you can also see here in the chart though, the weakness, I would say, of an index fund, especially in the Philippine case, for instance, over the past 10 years is what we've seen. It's been a boom bust market eh. So ito na yung minimension natin kanina na urong sulong. Akyat siya, sole. Akyat siya, sole. Akyat siya, sole. Akyat siya, sole. In a sense na it's hard to build wealth because of that type of environment. So in theory, actually during the 20-year investment period, diba, if you were just holding the index fund, parang in theory, dapat yung ginawa mo, you sold at the top 8,000 and then tumabi ka na lang. And then you just you bought it na lang there, diba? At the points in time wherein it was lower. And if you look at it, even if you were actually just looking at the index itself and some of the major issues that are there, but not all assets, not all stocks also performed well during that 10-year boom bust time frame. So in fact, like I say, we highlighted PLDT here, down 52% during that 10-year period, because at the beginning of the past decade, PLDT was the largest stock in the index, and it was actually down. It was down that much, diba? So very, very tough siya. And I think the issue there in terms of, and this helps actually differentiate what the value proposition is of one versus the other. Like it's a index fund versus the CSG, wherein it can dynamically allocate between asset classes. Is that yes, stocks are the better performing asset class over the long run, but that's over the long run. In like let's say the middle, in terms of the path, it's not also always the case. So like let's say yung nakita natin, there are several years, so highlighted here by the yellow, ALFM, and I emboldened it. These are years wherein bonds have performed better than the stock market. So over the last 20 years, so yan, on an absolute raw diba, basis, yes, stocks have better returns over bonds, but annually, they're only better 50% of the time. So kung na-tsempo ka, like let's say, nakinailangan mo yung pera mo na naka-invest sa stocks, and this is the type of year that you saw, down 48%, for example, yung PSE index na global financial crisis ka, iyari na siya, di ba? Ang laking soli nun eh. So yes, on a raw return basis, you're gonna reap more return from stocks when things are good. But when things are bad, they're also more volatile. Mas magsusoli ka din. So for if you're an index fund investor, parang ganito yung makuha mong returns. Unless of course you trade your index fund also and matatimingan mo na top of the market na, pwede ko na muna siya ilabas. Then okay, that makes sense, diba? But when you buy an index fund, who's also going to tell you that it's time to sell? It's gonna be your own call as an investor. So the difference in terms of like where the CSG comes in is we make a value and a judgment call. What will be the better asset class? So hindi natin necessarily kailangan i-invest lahat ng pera na meron tayo into stocks. So like let's say kayo, kapag nilagay niyo yung pera niyo, for instance, in an index fund like the CIF, it's fully invested right away in the index because it's the nature of the index fund. But if you put it into the CSG, your fund managers will still come up with an allocation. If number one, okay, we receive money. Given where the market is at, do we need to invest all of it right away? That's number one. Number two, okay, where do we invest it once the money comes in? But do we need to buy more bonds right now, given that it looks like that will perform? Or do we buy more stocks right now, given that that's what could potentially outperform. So what we just have here, just to continue on this study that we're discussing, if we actually measure, so of course this is a perfect world and theoretical scenario, no? But like let's say, what if we are able to every year choose the better asset class, whether it's the index, the PSE index, or um try to buy or like let's say bonds using a bond index. So that's why meron kami ditong 80-20 and 70-30 flexible portfolio. So the theory lang behind that is, what if diba, you could shift 80% of the portfolio into either stocks as represented by the index or bonds, depending on what's better for the year. And at least what this study showed is that malayo yung return niya. So a portfolio that's been able to shift 80% into 80% or 70% of its allocation into the better asset class for the past 20 years, either stocks or bonds, beats a pure stock portfolio by 474% for the 80% or 201% for the 70%. So, I mean, I'm not saying magagawa natin to, yung complete shift na yan. But just the fact that you're able to move into what's better instead of just being fully invested, like it's in equities, is what adds value to what the CSG could do. But it also doesn't mean you just forget all about the index fund, because there's also a purpose for it. So in terms of that, so may purpose din yung index fund if what you want is a pure direct equity exposure. So if you're someone who could really time the market and you feel like equities are really going to rally and rally strongly, and you don't want the risk of, like let's say, just buying a single stock na syempre mas may risk yun given developments that happen inside the company, you buy the index. So if you're an investor and you want to build wealth through direct equity exposure, dito ka. It's just that it could also and you know, when equities and when markets, if it's a risk on environment, this is the asset class that could really rally more and rally more quickly. Kasi 100% invested siya into equities. But if you're more of a hands-off approach, you're a person who would maybe desire less volatility over the long term, and you're seeking to build wealth over time with a more hands-off approach. But you want somebody to make the calls for you in terms of, okay, it's time to take profit na, or it's time na, oops, yung market mukhang alanganin pa, wag muna tayo mag-fall on there. That's when you go CSG. So the CSG is actively managed, and the asset allocation is flexible. Whereas the CIF, it's really gonna try to give you the return of the index at large.
So CSG Zerge tries to lower yung volatility of investing because you're able to move into assets that help preserve yung wealth that you have. So it's
Yes.
better for a wealth building approach kasi you're able to tactically move between different assets. And na maganda yung stat na pinakita mo kanina, that was very surprising, that if you can do it perfectly, you would actually be able to outperform even the index kasi you're able to navigate outside of the downsides or volatility ng market. So that's very interesting. And yung differentiation mo between CSG and an index fund. Okay, so CSG, for people who have more hands-off approach and would like na kayo na yung mag-manage ng asset allocation, whereas an index fund, that's your pure equity exposure. So kung gusto mo lang mag-invest in Philippine stocks, this is the quickest and easiest way to do it. Okay. Right. So lastly, Zerge, any final thoughts or key takeaways for our viewers regarding investing in the Philippine markets during these transitioning periods?
Yeah, sige. Yeah, thanks Zane for having us for this session. So if there's any singular advice and takeaway that could actually give our investors right now, it's this one. It's to be active. So I don't mean that in a self-promoting way, but I just want to say be active in a sense that you really need to take better stock of your investments, especially given today's environment. So either you can be active in a sense that you let professionals do the investing for you, or you take a more active approach in terms of how you manage your investments. So, like let's say maybe the strategies of the past, such as just simply buying and holding, but from what we've seen and experienced, especially in terms of the Philippine market over the past 10 plus years, it doesn't seem to kind of work in today's environment. There's just too much volatility with the advent, like let's say, of social media nowadays. There's also just too much noise. There's too much also going on. Like let's say, even with the advent of passive funds, a new asset class, like let's say cryptocurrencies, wala naman yan dati, diba? All of these things are going on around us, diba? And things are happening at a faster pace because information is in everyone's fingertips. So if you're not, like let's say, careful, if you don't watch your investments, diba? If you don't apprise yourself with what's happening in the world at present, it's possible that your investment could go down, either go down in value or couldn't be maximized. So yeah, I encourage everyone to, like I say, with the investments that you have now, diba? Have your eyes, ears open also to the opportunities that are out there. So for me, I view, like let's say, times when interest rates are high as actually interesting times. If interest rates are high, it also means, I mean, that's a period where I think people could make a lot of money, either just like even by investing in fixed income products, or if you're investing in an equity market, but it's expected that equity should be able to generate a return that's better than fixed income. Um, if you don't have the time to be active yourself, find somebody who could be active for you, such as, like let's say, what we do here at CMI, COL investment management, especially with the CSG. We already try to manage clients' portfolios on their behalf the best way we know how, through all of the market's ups and downs. So yeah, that's really pretty much it. Open your eyes, open your ears, open your opportunities that are out there, and just be active.
All right. So thanks a lot, Zerge, for joining us this afternoon.
Yeah. All right. Thanks, Zane. And see you again next time, hopefully.
The takeaway I got from our interview today is that the local market remains sensitive to different factors like inflation, interest rate expectations, and even geopolitical tensions. But structurally, there seems to be no issues with the market today. One concern, however, is the high interest rates that present a competition in the form of fixed income. So given this type of environment, being active in terms of your asset allocation and stock selection, whether by managing your personal investments or by having a fund manager like CMI, will allow you to stay invested in the local stock market for the long term.